Happy Friday, Brian Manning here with the weekly update. Let's get right to it. Monday this week, relatively quiet news day. Not a lot to talk about there. Let's just jump to Wednesday because that's actually when things get heated. So I can't believe it. It's first week of the month already. Another month has gone by. So the first week of every month, we get employment data. So the first Wednesday of the month, we get ADP. So ADP is the largest provider of private payrolls in the US. This is employment data for the month of April. And we got 192,000 new jobs created in the month of April. Expectations was 183,000. So that was, a little better than expected, but pretty much in line with expectations. Also, Wednesday, really important, was Fed Day. So Fed adjourned a 2-day meeting. Then you have Jerome Powell speaking. He goes through a press conference. And there's a lot of very important things for us to look at here. So the first thing Jerome Powell came out and said is that rate hikes are really not on the table. It's not an option. Well, that definitely calmed the markets down because a lot of markets were looking at inflation being sticky, the employment market being strong, and really concerned that if inflation was not moving in the direction that the Federal Reserve wanted it to, potentially the Federal Reserve would hike rates to go the totally opposite direction of what we're all hoping for. Well, Jerome Powell, he was kind of questioned on that. He was drilled on that, and he very sternly answered the questions and said rate hikes are really off the table, which is amazing to see. The second part that's really important is through COVID and through quantitative easing, the Federal Reserve's balance sheet has swelled to trillions of dollars, and they're going through this runoff of the balance sheet right now. So they're selling mortgage-backed securities and U.S. Treasuries. So there's been a lot of supply going into the market for these securities. And when there's more supply than there is demand, then the rates have to increase so that investors are really enticed to start absorbing the supply. Well, we've been hoping that they would do this, and they alluded to this in the last meeting, but they finally came out and said that they're going to slow down, the tapering and the runoff of their balance sheet, which is really amazing. So right now, they're going to slow it down from treasuries where they've been selling $60 billion a month down to $25 billion a month. Which means they're going to be continually reinvesting about $35 billion a month in treasuries. So there's a huge decrease in the runoff of their balance sheet. It's really welcoming for us to see as time goes on. This should be favorable for interest rates, and we'll have to watch them even more. But this is one of the good changes we've been seeing and waiting for as far as rates are concerned. Then today, we get the BLS report. That's the Bureau of Labor Statistics. This is the employment report for the month of April. Expectations was that we would see 240,000 new jobs created in the month of April. We got 175,000 new jobs created. So I would say that was a miss. Investors were happy to see that because if we keep seeing a very rosy employment picture, that really doesn't give the Federal Reserve much need to lower rates. So it's good to see a lower than expected employment report there. The second item we're going to look at is going to be unemployment. Unemployment ticked up from 3.8 to 3.9%. The reason why this is important is because the Federal Reserve has two mandates. One is price stability, so they're controlling inflation, and the second is full employment in the US economy, right? So if inflation is sticky, right, the Fed's goal for inflation is to get to 2%. It's been sticky in that 2.7 to 2.8% range. If inflation's not moving its way down towards 2%, then the Federal Reserve is not going to cut interest rates. But the second component of that is going to be unemployment. They've all pretty much said that about 4 to 4.1 is their threshold of unemployment. So if unemployment exceeds 4.1%, that would likely lead us to Federal Reserve rate cuts. So to see unemployment move from 3.8% to 3.9, we're only a couple tenths away from where the Federal Reserve would probably have fuel on the fire to lead to an interest rate cut. Again, it's probably not going to be inflation, so unemployment is what we're looking for. Additionally, what helped the bond markets today was average hours worked. So average hours worked looks at employees across the country and how many hours are they working on a weekly basis. And this dropped from 34.3% to from 34.4 down to 34.3. It doesn't sound like a lot. The reason why I bring this up though is because the trend of hours worked has been moving lower. The reason why this is important because if you're an employer, usually what you're going to do first is start lowering your employees' hours that they work per week before you lay them off because it's harder to rehire employees. So this trend over time has been moving lower and lower and lower. And right now we're only 1/10 away from the lowest number of hours worked since 2011. So this is probably leading us to where we're seeing more unemployment, which in the future will probably will lead us to Fed rate cuts. I'm around all weekend. If you have any questions, let me know. If you want to learn how we're closing purchase transactions in 10 days, that's right, 10 days, give me a call. If you're a realtor, make sure you sign up for our Winning the Buyer presentation, taking advantage of the NAR settlement. We got a couple classes coming up, one next week in Boulder, the following week in Fort Collins. After that in Denver, we're getting rave reviews. People are really loving the content. We'd love to see you there. Happy Friday. Hope you have a great day.